Hi everyone and welcome to chapter number 2. So in this we are going to discuss the overview of Canadian financial marketplace. So important topics are the regulation parts that we will see at the end of the discussion. So let's start with it. So the first part in the book, it discusses about what is an investment capital. So what is capital? Capital is wealth. It could be wealth in physical form. So it could be a factory, it could be a land, it could be real estate, or it could be in securities form. So it could be an investment in stock, it could be an investment in a bond, which are paper based. Okay, so wealth has physical aspects or like security aspects to it. So capital represents the invested savings of individual corporations and government and is arguably the world's most important commodity. Therefore, capital is extremely selective and it can be real or representational. Real means physical, land, building, machinery, and representational, it means money, stock, bonds, or mutual funds, which are paper based or electronics based. Okay. Capital has three important characteristics. It is mobile. What does that mean? That there is a global capital marketplace and the capital from one country moves to another if it finds better investment opportunities. So example of that, a lot of Canadians actually invest in the US stock markets more than the Canadian stock markets. So why is that? Because the returns in the American market has been better than the Canadian markets. So that's an important consideration, that capital is mobile. It is sensitive to the environment, so the political stability, right, the situation, the business friendliness, all of this is important for capital. If the country is not politically stable, if the business environment is not friendly, then the capital moves. It's also scarce. It doesn't grow on tree, right? It has to be generated through savings, so it's not abundant. Now, there is a country's risk evaluation which determines where will the capital go, which country the capital will focus on. So risk that determines where the capital will go are political environment. Is the country involved in internal or external conflicts? So for example, like capital going in Russia or Ukraine has been impacted because of the war, because it's not a politically stable environment. So people will not be comfortable investing in, let's say, Russia or investing in Ukraine. Economic trends matter a lot. Gross domestic product, inflation, level of economic activity, all of these are important consideration that investors look at. The GDP should be growing, the inflation should be low, the economic activity should be vibrant. Only then the capital will increase in your particular specific country. The fiscal policy, the taxation, lower taxation is preferred by investors, and government spending, lower government spending, like capped government spending, decent government spending is preferred. Then what is the monetary policy? What is the interest rate environment? That is the money supply environment, right? What is the price stability? How is the inflation, right? Is it low? Is it trending downwards or is it trending upwards? All these are important considerations. And what is the investment opportunity? How much return can the investors expect? So that is also an important consideration that capital has to feature. Then what is the labor force? Is it skilled? Is it productive? Does it have adequate supply? Right? All these are important consideration. If the labor force is shrinking, like some advanced European economies, then the capital also starts to dry up, because people do not like investing in a shrinking labor market. Productivity is also important. Like if you compare United States and Canada, the productivity per person in Canada is lower than United States. United States has a higher productivity than Canada. So capital prefers productivity. So people sometimes prefer the United States because of that. Then what are the sources and users of capital? The only source of capital is savings. So it could be an individual saving, it could be a company saving, right? That is retained earnings of companies, or it could be government running surpluses, that is savings. The sources are lenders of capital and users are borrowers of capital. Then these savings get funneled to borrowers, people who want to use that like collective saving to do something. Okay. There are a lot of non-financial corporations such as manufacturers, food distributors that generate large part of the total saving, which they retain and reinvest in their business. So a lot of businesses work in surpluses. So whatever surplus they have, they try to reinvest back into their business. Because these funds are internally generated, they are not usually available or invested in other businesses. So these companies who hold majority of savings do not actually invest in the outside companies, right? They try to build up their own companies. Then individuals may decide to save, that is postpone consumption, so that they can consume in future. Individuals are a big chunk of money that like the saving world has. Trillions of dollars of individual money is being invested around the world. That is their big source of capital. Governments that generate budget surpluses can use those funds to save for future needs, or they can pay down debt. So when government have surpluses, right, Canada hasn't had surplus for quite some time now. Last surplus that we had was 2014, if I'm not wrong, 2015, right? So if you have a surplus, if a government has surplus, then they can use it to either invest in things or they can pay down their debt. Government that generate deficits, budget deficits, will need to borrow money to finance those deficits. So whenever expenses of a government are higher than income that the government generates, then they have to borrow money to fuel those expenses. There are three main sources of capital. These are retail investors, individuals who buy and sell securities for their personal account with small amount of money. Then there are institutional investors, organizations such as pension funds, life insurance companies, mutual fund companies that trade large amount of securities with large amount of money. And there are foreign investors, which are a significant source of investment, mainly with foreign direct investment, in which funds are used up to start up new or existing companies. Industries such as manufacturing, natural gas, right, or mining, right, are the main things in Canada where people invest. So majority of foreign investors focus on our resource industry. Resource industry gets large chunk of money from foreign investors. Now between these three, right, institutional investors also provide a big source of money and large amount of money, so because they trade in larger quantities. Okay. Then there are, I'll just close the door. Then there are also users of capital. Who are users of capital? So these are mostly individuals, businesses, and government. So individual generally do not borrow much from the security markets. They mostly borrow from the banks. So individuals do need capital though. Capital is needed to acquire major assets such as housing, consumer durables, or any kind other types of consumption. So you need money, right? You need money to buy a house, you need money to buy a car. Usually people borrow that money, right? Whatever they require. Capital is usually obtained through personal loan, mortgages, or credit cards. Businesses need massive amounts of money to finance day-to-day operation, expand, and maintain plant and equipment. Much of it is generated using internal profits, The rest of it is borrowed from banks or from the security markets, right, such as short-term money market accounts or medium and long-term debt and common and preferred shares. Okay, one important thing, individuals do not participate in the security markets. They mostly deal with banks. So you do not issue stocks as an individual and borrow money, or you do not issue a bond as an individual and you borrow money. Businesses can do that. Then governments also require capital. So governments are major issuers of securities in the public market, either directly or indirectly through guaranteeing debt of their crown corporations. So let's unpack this a bit. So governments borrow money for sure. They borrow at all three levels. They borrow at federal level, they borrow at provincial level, and they borrow at municipal level. Now there is different ways to borrow for government. They can either borrow in their own name, that is the government borrowing itself. For example, the government of Canada borrowing or government of Alberta borrowing. They can also borrow using crown corporations. Crown corporations are companies that are majoritarily owned by the government. Okay, so they can borrow using crown corporations, and that also is a thing. For example, in British Columbia, right, most of the auto insurance is done by a crown corporation. So provincial government of British Columbia, BC, has a crown corporation that does insurance. So if that crown corporation borrows money, it is effectively indirectly government of British Columbia borrowing money. So again, governments borrow at three levels: federal, provincial and municipal. Now government is also a user of capital, right? So federal government, when the revenues, taxes fail to cover expenditure, most of the time it happens, or when large capital projects are planned, the federal government must borrow money. The federal government uses two main instruments to borrow: treasury bills for short-term borrowing and marketable bonds for long-term borrowing. Now provincial governments borrow money too. Unlike the federal government, the provinces issue debt directly. They borrow for the same reasons: tax revenues fall short of spending requirement, or large capital projects are planned. They tend to borrow by issuing bonds through a syndicate of investment dealers to financial institutions, institutional investors, or retail investors. Now it's important to note, sometimes provincial governments also borrow from the federal government. So they issue bonds which are bought by the federal government. So the federal government is providing money to the provincial government. Some provinces can issue their own short-term treasury bills or their own version of savings bonds. Then the cities borrow too. Municipalities are cities. Many of the projects that municipalities undertake, streets, sewers, transportation, like metro projects, delivery of utilities, are expected to last 20 years or more. Municipalities attempt to spread their cost over a long number of years and finance them by selling debentures, which are similar to bonds. Municipalities have the same challenges as provincial and federal governments do. Their cash receipts do not cover their expenses. Next, how do the borrowing happens? Borrowing usually happens using securities. So what are securities? Securities are contracts. These are formal legal documents that are ways in which the capital can be distributed between the source, that is people who have it, savers, and borrowers, the users of that capital, investors, buyers, and issuers and sellers. Securities set out rights and obligations of buyers and their sellers and have standard features that facilitate their trading. There are 5 main types of financial instrument. There are debt instrument. What is a debt instrument? A company is borrowing money with 2 conditions: that they will pay regular interest, and when the borrowing period is up, they will give back the principal. They will give back the face value. So this is a debt instrument. Equity instrument is stock ownership, in which you're selling ownership. So the person who is buying ownership, right, investor, usually becomes part owner of the company. Then there are investment funds, right, which are collectives, so people pool their money. Then a fund manager manages that money and then they invest. Derivatives are indirect ways of betting on stock prices, so they derive their value from one or more underlying. We'll discuss all these topics in greater details as the course proceeds. There are other financial instruments also that are part of the game. So debt is also known as fixed income securities. They formalize a relationship in which the borrower promises to repay the loan at maturity. So whatever they have borrowed, they give it back when the bond matures, and in the interim make interest payments to the investor. The term of the loan ranges from very short, few days in case of a T-bill, to a very long period, 30 days and beyond, depending on the type of instrument, right? So 100-year bonds are also there. Primary examples includes bonds, debentures, mortgages, treasury bills, and commercial papers. Then what is equity? Equity is usually referred to as stocks or shares because you're buying ownership, because the owner actually buys a share or a piece of a company, gaining them a stake in the company. As an owner, the investor participates in the fortune of the company. So if the company does well, the value of your investments go up, right? If the company doesn't do well, the share prices, the value of your investments go down, causing the market value of the shares to rise, giving the investor a capital gain when the shares are sold. Also, one more benefit of buying stock is dividends. So what are dividends? The company can make some profits, and from that profits they can pay out cash to shareholders. That is called as cash dividend. The company may distribute part of its profits to its shareholders in the form of dividends. Unlike interest payments though, dividends are not mandatory. So the company is not mandated to pay dividends. Interest payments are mandatory. If they have money, they have to pay it. There are two main types of equity: common shares and preferred shares, right? We'll talk more about this in the coming chapters. Then there are investment funds. So what is an investment fund, right? It is a collective. So an investment fund is a company or a trust that manages investment for its clients. So clients contribute money and the company manages it for the client. The most common form is a open-ended, also known as mutual funds. Mutual means held in common by two or more parties. The fund raises capital by sharing shares or units to investors, and the fund invests that capital. As a unit holder, the investor receives part of the money that the fund managers make from the investment. So whatever after fees returns are there, those are given back to the shareholder. Either the unit value increases, right, or the funds provide dividend too. Then there are derivatives. Derivatives are suitable mostly for sophisticated investor. Retail investors do not invest in them or do not trade them. They are an investment product that is based on or derived from an underlying instrument such as a stock or an index, but also can be based on commodities. The most common type of derivatives are options and forwards. Okay, the average investor will seldom venture into these type of investment product because of the need for great deal of education, a willingness to take higher risk, and often high cost to produce. Investment dealers have used the concepts referred to as financial engineering to create structured products that have various combinations of debt, equity, and investment funds. So there are other financial products too created using financial engineering. The two most common are linked notes. So these are banking products in which the return, the interest rate, is based on the stock market. We are going to discuss this in the future chapter, so I'm not going to elaborate much on that here. Then there are exchange traded funds, right, which have like features of stock and a mutual fund. You have an assignment coming up, so we'll talk about it there. Also, the course discusses them at great details. The next topic is there are financial markets to facilitate trading. So there are savers on one side, there are borrowers on other side, investors on other side. So generators of capital, users of capital, right? Financial market facilitates the transfer. It helps the transfer. So securities are a key element in efficient transfer of money, capital from savers to users. The benefit of investment product depends on the existence of efficient market in which the securities can be bought and sold. So it's important that markets be efficient. What is efficient market? The book states like couple of features that the market needs to have. The trading should be low cost. The trading has to be efficient. Then the difference between bid and ask price, right, should not be very large. Okay, and it should be easy to buy and sell. Okay, bid and ask we are going to discuss when we discuss stocks more. A financial market or a security market provides a forum in which the buyer and sellers meet but not face to face like in the farmers market or car dealership. So most of the times when you buy stocks or when you buy bonds, you do not know who is the other side, right? And you don't really care because you don't have to meet in person to trade. Instead, intermediaries such as investment advisors or dealers act on behalf of their clients. Security markets do not normally involve a physical place, which is made possible because securities are paper based, that is, they are intangible. Okay, the capital market is made up of many individual markets like stock market, bond markets, and money markets. In addition, securities are sold in primary market and secondary market. So capital market is where stocks, bonds, and money trade. So stock market, bond market, and money market, that is the currency market, put together is called as the capital market, right? Now within this capital market there are two types. There is primary market and then there is secondary market. What is primary market? This is important for the exam. Primary market is where new securities are bought and sold by people. So new security means the company is selling its shares for the first time, or the government is selling the bonds for the first time, right? So you're directly buying from the source. Company or the government, right? That is called as a primary market transaction. Mainly stocks and bonds are sold by companies and government for the first time. When a company sells the stock for the first time in the primary market, that is known as initial public offering, IPO. Mutual funds are also sold in primary market. Whenever you buy a mutual fund, most of the time you directly buy from the mutual fund company. The secondary market is where the company is not involved. So people who have already bought the securities, then they are selling. So secondary market is where investors trade security that have already been issued by companies and government. The issuing company or government does not receive any of the proceeds from the transaction in the secondary market. This is a key important point. Whoever is selling in the secondary market, right, the company or the government doesn't get the money. For example, let's say we are considering Tesla. I hold some Tesla shares, and if I go out and sell it in the secondary market, that is the stock market, Tesla is not going to get any part of that money, right? I am selling my shares, so I get the money, and someone else who is buying those shares, right, they get the shares. Tesla is not involved at all, right? They don't receive any part of the proceeds. The issuers already received payments when the securities were originally issued in the primary market, when those investments were first made available to the public. So the issuers have already got their cut, right, in the first go when Tesla issued shares to me, right? Now they are not part of the transaction. Markets can also be divided into auction markets. Auction markets is where all the orders are collected and they're put in a common place, and then the order matching is done. Or a dealer market where a dealer deals with another dealer. Now what are auction markets? Auction markets involves buyers who enter bids for stock they want to buy. Whatever stock you want to buy, you have to insert the bid price for that. Buyers insert the bid price, the price at which they want to buy. Sellers enter the offering price, the price at which they are offering, right, for the stocks that they own and they want to sell. Then order matching happens. What is order matching? The price at which the stock is traded. It depends on matching of highest price a buyer is willing to pay, the best bid, and the lowest price a seller is willing to accept, the best offer. So between best bid and best offer, the order matching takes place. We'll elaborate this more when we talk about trading in the equity chapter. These orders are channeled into single central market where they compete with other bids and offers. Next, Canadian stock exchanges. So what is a stock exchange? A stock exchange is a marketplace where buyers and sellers of securities meet to trade with each other and where prices are established according to laws of demand and supply. So stock markets is like a common place where buyers and sellers put their orders. They don't meet in person, they put their orders and order matching happens. Trading is carried on in common and preferred share, rights and warrants, listed options, future contracts, installment receipts, exchange traded funds, income trust, and few convertible debentures. All these products we are going to discuss in the next class, in the future classes. Liquidity is fundamental to operation of an exchange. Liquidity means how efficient is the market. A liquid market is characterized by frequent sales, so sales are happening fast. There is narrow gap between bid and ask prices, so there is narrow spread between bid and ask price. What is the spread? Difference between bid and ask price. The spread needs to be small, and there are small price fluctuations from sale to sale. Now there are different stock exchanges. So there is Toronto Stock Exchange, there is TSX Venture, there is TSX Alpha, there is Canadian Securities Exchange, Montreal Exchange, Neo Exchange, and Natural Gas Exchange. So this is a slide that mentions all of them. So what trades on TSX? So there are overlaps too. So a lot of things trade on a lot of exchanges. So TSX lists senior equities of major firms. So bigger companies generally trade on TSX, Toronto Stock Exchange, and also some debt instruments. Then TSX Venture Exchange, they trade junior securities, smaller companies, and few debentures. TSX Alpha Exchange is an alternative platform to TSX and focuses on technologies and financial companies. So mostly tech and finance companies trades on TSX Alpha. The Montreal Exchange is for financial derivatives, financial and equity, futures and options. The ICE NGX is a exchange, right? It's a clearing and data service for natural gas and electricity market. So if you want to buy natural gas or if you want to trade electricity, you can go there and trade. CSE specializes in emerging new or newer companies. Neo provides listing and trading services for securities that list on its TSX and venture exchanges. So Neo is like a consolidation. Okay. Then there are also dealers market. Bonds usually trade using dealers market. So dealers market consists of networks of dealers who trade with each other, usually over phone, more likely using computers. Unlike auction markets where individual buyers and sellers orders are entered, a dealer market is negotiated markets where only dealers bid and ask quotations are entered. This is an important statement. You have to remember this. In a normal stock exchange, retail investors or institutional investors directly put their orders. In a dealer exchange, they do not put their orders directly. Only dealers are allowed to put their orders right on like with each other, right? So you have to go through a dealer to trade if it is a dealer exchange. Almost all of bonds and debentures trade are sold through dealers market, which are less visible than the auction market. Dealer markets are also called as over-the-counter markets or unlisted markets because the securities that trade are not put through the organized exchange. So over-the-counter is a dealer market. So you're buying, your dealer is buying from some other dealer, right? So that is a over-the-counter market. Now important to note, OTC market, the size of it is way bigger than normal stock markets. Then there are money markets too. Usually money markets trade in debt maturing under 1 year, so treasury bills, and mainly which is government debt such as T-bills, including bankers' acceptance and commercial papers of companies. Then there are long-term capital markets, stocks that trade on exchanges and bonds that trade over the counter. Then there are financial derivatives market, which are financial and equity futures and options that trade on Montreal Exchange, right? Options trade OTC and commodity futures trade on ICE Future Exchange. And there is foreign exchange market in which currencies trade. So foreign currencies trade that mainly involve bank trading with large corporate clients. Now, to facilitate trading, there are financial intermediaries. These are organizations that assist with transfer of capital between suppliers and dealers, suppliers and users. There are two types of financial intermediaries: deposit taking. So deposit taking means they take on deposit and use that deposit to make investments, right? So these are banks, trust companies, and credit unions. There are non-deposit taking intermediaries too. For example, investment dealers and brokers, they don't take deposit, they just help to organize the trade. Life insurance companies, they don't take deposits, they collect premium and use part of that premium to invest. And then there are investment funds, mutual funds. Then there is a role of an investment dealer. There is another type of non-deposit financial institutions that is also known as brokerage firms, security houses, and investment bank. They serve two functions. They help to transfer capital from savers to users through the process of underwriting and distributing of new securities. This we are going to cover in the next, in the upcoming chapter in equity. What is underwriting? Usually underwriting means guaranteeing that you are going to sell the stock, right? Which takes place in the primary market. They maintain the secondary market in which previously issued securities can be traded among investors, enabling the security market to have liquidity, the ability to buy and sell securities with ease at reasonable price. Now, all this trading needs to be protected. So there are laws that protect this infrastructure. So there at federal level, there is Consumer Protection Act, the Criminal Code, Bank Act, and Canadian Business Corporation Act, that is a protection mechanism. But more relevant than that is the provincial regulations, because security trading and financial intermediaries are security trading at least is treated it's treated more provincial matter. So there are provincial and territorial security administrators who regulate the security trading. There are registration, disclosure, investment, and prosecutions done by the provincial governments, and they are responsible for administration of Provincial Securities Act. So this is a difference between Canada and United States. United States has a federal security regulator, okay, that is called as SEC. It's a federal body. all over the United States they regulate. Canada doesn't have that. Canada has provincial ones. So Alberta does it for Albertans, right? Ontario Securities Agency does it for Ontarians, so on and so forth. Then there are also self-regulatory organizations, right? These are private industry organizations that regulate only their members to ensure that they conform with security regulations. Okay. Now there are multiple rules. So if an SRO rules differs from a provincial rule, always the more stringent rule of the two applies. This is important for exam. Any law that is the most stringent, you as an advisor have to adhere to that. So the most stringent law you have to follow. There is MFDA, Mutual Fund Dealers Association, which oversees the distribution side of the mutual fund. So you as a mutual fund agent, after doing this exam, will be regulated by MFDA. There is a counter body to this. There is a separate body, IROC, Investment Industry Regulation Organization of Canada, that regulates the member who sell investments including mutual funds and also stocks and bonds. In Quebec, they have a separate system altogether. There is Autorité des Marchés Financiers, AMF, and Chambre de la Sécurité Financière, which regulate mutual funds in Quebec, right? AMF is responsible for regulating the funds, and Chamber Security Financier is responsible to regulate agents. Okay, so Quebec has their own separate system. So that completes chapter number 2.